We have Nilesh Shah of Kotak. Dharmesh is also joining us from DAM Capital. And of course, Sandeep is right here in our studio. Gentlemen, afternoon, all three of you. Nilesh, I'll start with you. This time around, the commentaries seem to have cheered the bond market more than the stock market, especially on the drop in yields was not very expected. What are your thoughts? Do you think it will remain soft and hence financials could remain active by the sheer 5.1 number which was shared this time around on fiscal deficit front?
Me over here. Undoubtedly, the fiscal deficit number of 5.1% was well beyond the expectations of the debt market. Yesterday's announcements by FOMC also probably laid the foundation for rate cuts, albeit in second half of CY24. And this, coupled with the lower net borrowing program, does give confidence for markets that the yield which we will see in March 25 will be lower than what we are seeing today.
Okay, so that's about how the fiscal glide has been maintained by the government, and that's good to hear. I also wanted your take regarding the capital expenditure, Nilesh, because that the street was expecting will slow down to single digit, while of course the growth rate for the last 4 to 5 years has been over 25%. It's now down to 11%. Are you disappointed? Are you seeing it as glass half empty or glass half full?
So point number one, this year's capital spending target of 10 lakh crore is being revised down to 9 lakh 50,000 crore. So government also has limitation on spending. There are approvals processes and also CBI, CAG kind of checks. Second, on the revised estimate of 9 lakh 50,000 crore, there is a 17% increase, almost comparable to last year's 20% increase. Third, government has consciously decided to follow the path of fiscal prudence, else capital expenditure could have been even higher. My feeling is that there is more productivity in spending thanks to faster approvals and faster turnarounds. And hence, the 17% increase to 11.11 lakh crore is adequate enough. More importantly, this should act as a catalyst.
That more continuity was visible on the reform front, and it appears that the government is very confident of coming back. In fact, Finance Minister spelled it out saying we will be presenting a full budget very shortly, confident of coming back. You interact with all kinds of investors, not only domestically but overseas as well. When you interact with them and they must be taking feedback from you, what are they looking for right now? Because there is so much of reform work already done, probably the room to surprise from here on further may be low.
So if you hear the budget, it was an interim budget, so nobody expected too much out of this budget, especially in the tax reforms, because there is any scope to do that in this budget. But if you look at the messaging which has come out very strongly is about growth. You're talking about infrastructure building up. You're talking about capex coming back in a big way, and housing side. So if you see the right noises have already been made, and the key points and the key initiatives and policies will actually come out in the normal budget post elections. Yes, very strongly the finance minister has indicated they are coming back, and that's the reason we have given this kind of a growth path, like this kind of an indication what they are going to plan in the next budget coming, and that is exactly what people wanted to hear. I don't think so people wanted to hear anything different from what she has said, and in fact, it's just music to the ears that the government is going on a growth path, and now we're talking about large investments coming in once the elections are over.
Yeah, we'll watch out for those big, investments and the announcements as well. But Sandeep, what are you doing to your portfolio after hearing the budget speech? Is there any change that you would want to recommend in the portfolio, or just stick with what you have?
So per se, I don't think any portfolio change can happen just because of the interim budget. But I think the only thing which was very positive was the 0.8% reduction in fiscal deficit. Now, most people don't recognize it, but it's very significant. One, a reduction in fiscal deficit of this magnitude is disinflationary. So it will reduce the inflationary impulses, give more confidence to the RBI to actually reduce rates going forward. Secondly, it frees up a lot of borrowing capacity for the private sector. And thirdly, lower bond yields, because now we have not yet seen the 50 to 70 billion dollars of flows which the bond market is expecting after June, after India comes into the bond indices. Once that happens, it means that the lower bond yields will get entrenched, And typically lower yields, people think they are very positive for financials. Actually, lower interest rates are more positive for automobiles, consumer
interest rate
durables, industrials, construction companies. So, I think those are the sectors which should remain in focus.
In fact, Nilesh, I'd like to scratch that point a little further with you. The way, this fiscal deficit, I mean, in fact, our first starting conversation was on that. The number has been lower than even what the bond street was actually expecting. And the wider impact which Sandeep spoke about.
In middle of 24, RBI will probably follow through on that by end of 24. Second, while fiscal deficit is coming down, fiscal impulse is not coming down because more money is spent on capital expenditure. Combination of lower revenue deficit within fiscal deficit should ensure that this fiscal consolidation does not result into GDP growth slowing down. And more importantly, this vote on account and hopefully the next budget is trying to achieve a combination of trinity: support inclusive growth through consumption at the bottom of the pyramid, invest for future through infrastructure allocation, and yet maintain the path of fiscal prudence. So this is overall a budget which will definitely be liked by the debt market, and it will have its own impact on equity market valuation over a period of time.
But Nilesh, a lot of people are talking about how this could be one of those efforts made to improve the rating of the sovereign rating of India, that is. Do you really see that happening soon, or this is again a wishful thinking on our part, but we are still far away from that rating upgrade that we all believe is likely to happen soon?
Well, the name of the rating agency suggests that they are moody and they have poor standards. If we look at over last many decades, countries which have regularly defaulted have enjoyed higher rating than India. And India, despite Harappa Mohenjo-daro is still today not defaulting to any foreigner, has enjoyed a lower rating. So I don't think so we should expect a fair hearing from the rating agencies. They have two standards, one for the white men's and women's, other for the brown men's and women's.
As a professional investment banker, this is a good problem to have, right? Superior growth in the economy versus anywhere in the world, and inflation outlook and interest rate outlook on the lower side. But does it also become a challenge sometimes in terms of valuations, especially for good assets, or valuations overall in the country as well are towards on the higher side by some say they are rich to fair. You can tell exactly what's happening on your table.
Well, if you look at the IPOs, they're not coming at some crazy valuations.
Sure.
It is post-IPO listing when the valuations actually go crazy. So if you look at all the IPOs today, when you're seeing the upside which people have made, because the IPOs have been priced very fairly, one can always challenge the kind of assumptions people have taken, but that time will tell whether they can achieve there or not. But I believe, despite whatever the perception may be, people thinking IPOs are crazy, pricing it is not. So one thing is very sure, because we are in the midst of doing so many IPOs, it's not easy to value them in current environment because there is not go. So I'm not too worried on the valuation part, especially when we are going to value those IPOs.
Sandeep, let's get in your take in terms of what exactly these benefits by way of the welfare schemes, etc., are going to do all in all for the entire consumption sector. Remember, that has also been a bit of a weak link when it comes to the overall economic growth, as reflected by a lot of the auto companies, for instance. How is it that you're looking at some of these announcements and what it would mean for the sector as a whole?
See, I think social welfare schemes continue, and they are more or less similar to what they were earlier. There could be some tweaks here or there, but I think the big factor which held back inflation, the consumption, was high inflation of the previous 2 years, which led to a sharp spike in most consumer good prices, and as such impacted consumption at a time where there were some sectors of the economy like IT, etc., which were also facing employment issues. But I believe going forward things will be much better, because if interest rates come down, inflation remains entrenched, then eventually volume growth in the consumption side will come back, because if for an economy growing at 7%, we can't have consumption growth at 2-3%. So, eventually that will come back, and I guess that will happen next year. So, it gives an opportunity to buy consumer stocks which are trading at lower valuations now.
Nilesh, would you concur with that when it comes to the entire consumption space, that this perhaps gives an opportunity maybe to look at the sector more closely as a buying opportunity?
Undoubtedly, yes. As Sandeep mentioned, we can't have our economy running only on government investment and services side. We need consumption, especially in rural India, especially at bottom of the pyramid, and especially in mass market products. Now, to a great extent, some of this is subdued because people have migrated to higher levels. But a lot of it has been impact of inflation, impact of tight liquidity, and lack of fiscal stimulus, which we have seen in some of the other countries. We have our house in order, and now hopefully we will see this fiscal impulse resulting into higher consumption in rural, in mass market, and in bottom of the pyramid, catching up with urban consumption, with top of the pyramid consumption, with premium products consumption.
Thanks so much, Nilesh, for joining us today with your quick take on the budget and what the bigger ramifications can be of the budget on the equity as well as the debt market. Numbers for Titan should also flash for you on the screen because they're just coming out, so we'll track that as well. But the interim, let me actually take it across to Dharmesh. Dharmesh, there was a lot of mention of the sunrise sectors and the focus that the government has on it. Which do you believe could be those sunrise sectors? Because of course manufacturing has played out in a big way. There was focus on railways and defense. Do you expect that to continue, or there are newer sectors emerging on the radar of domestic as well as the foreign institutional investors?
AI-driven sectors. So whichever sectors benefit thanks to AI and its technologies, you're going to see them coming in. But I think so it's too early right now to say this. I believe those sectors to come to primary market is still many years away. So I would not jump into that. They are more for the private markets rather than public markets. But definitely, yes, you will see more sectors coming in. Defense, as we have seen, is now rising in a very big way. So same way AI-driven defense, those are still continuing this there. But I believe still the main theme will be the EMS, which is just beginning to grow. I don't think so you've reached anywhere close to what the EMS size should be. So I believe that will still drive the investments coming to India, especially on the FDI front.
Dharmesh, how's the IPO pipeline looking for this year in light of such good policy continuity? You're talking about a vibrant market. Give us some flavor of what all proposals are you looking at least the sectors, something interesting lined up?
Well, as I said, EMS continues to be, so we're going to continue to do EMS sector. There will be financials which will be raising money because everybody is now thinking that post the elections, credit offtake will pick up in a big way. All corporates we talk to are holding on the plans till they see the election going through, and that's when they start putting in more money. So you're going to see significant capex happening post elections in the country. And I would say some consumer companies also will try to tap the market. Whatever we are seeing on our plate, I think so it's overall, if I look at it, it's not one sector specific. Almost all sectors are going to come to the market to raise money.
Reactions as well of corporate India, and it's an interesting tweet that Anand Mahindra has put out saying that for many years I've been saying that we create too much drama around the budget and raise expectations about policy announcement because it's not the occasion for transformational policy announcements. Do you think that was pretty much what the expectation was this time around, that perhaps maybe in the month of July we can expect maybe some more concrete announcements, or it's going to be pretty much more of the same, a vision statement?
Sorry, was that for me?
Yes, Dharmesh, that was for you.
Yeah. I think so. Current interim budget, there was not any great expectations, as we know the nature of the interim budget. So yes, it will be July. Once the election is over, that will be the main budget people will look for. And if the same government comes, obviously people look at the policies, growth policies, what they already indicated in the interim budget and build on that.
Sandeep, just wanted to get in a sense from you as well as to what the expectation is come July.
On the negative side, there are expectations on some tweaks on capital goods, some sort of inheritance tax, etc. coming. So hopefully those things don't come.